welcome to this episode of IPO KYC. I am Reema Tendulkar, and today we're focusing on a leading automobile dealership company, Popular Vehicles. They've come up with a nearly 600 crore IPO, which comprises of a fresh issue of 250 crore rupees and an offer for sale of about 350 crore rupees. The company has set a price band of 280 to 295 rupees per share. To talk more about it, we have with us Naveen Philip, the promoter of the company, and the MD, Raj Narayan, the CEO, and John Verghese, the CFO of the company. Gentlemen, thank you very much for joining in. So Popular Vehicles is one of the large automobile dealerships in India. But this is a very competitive space. Now, in the passenger vehicles, and I'm not talking about two-wheelers and three-wheelers, nearly 4 million vehicles are sold every day, and we have 2,000 to 2,500 dealerships, automobile dealers in India. So it's a very competitive space, fairly fragmented. So first, give us the market size per se, and for Popular, you're present only in 3 states. 4 states now, but predominantly in 3 states, which is Kerala, Tamil Nadu, and Karnataka. So what would your market share be?
So we'll have to split this into 2 parts. So our focus is on service. So Popular Vehicles and Services, we are a 7-decade-old company. And we are servicing, last year we serviced close to 1 million vehicles, okay? Which is by far, in terms of sheer volume, is by far across the country, one of the largest. So in terms of Maruti, we are the largest. In terms of service, we do about 650,000. So there's a very difficult part in terms of how many vehicles get serviced. For example, we service 20 times plus of the number of vehicles that we sell.
Okay.
But if you look at the top 10 dealers across, it's only 10 times. So market share in service is very difficult to calculate, but we are the largest in terms of that number. In terms of sales, we sold approximately 40,000 vehicles across these 4 states. But each of these markets, so example, Maruti in Kerala, we are at around 26% market share. Okay. Whereas Tata Motors in Kerala for commercial vehicles, we are at 80% market share. So we are probably number 2 in Maruti, number 1 in Tata Motors. Similarly in Chennai, where we have Maruti. We're number 2 in Maruti for Chennai, where we have a certain about 18-19% market share, I think. And Tata Motors, we are number 1 again in terms of the markets that we are present in. But the key focus is in terms of service, and there we are leading across the country.
Just to add to what Naveen mentioned, I mean, there are very few players in India who's got such a vast, we're operating in more than 4 or 5 states in India and having more than 100 outlets. There are very few. In fact, we're in the top 6 dealerships in the country in terms of volume for the year FY23.
Okay. In terms of volume. And in terms of revenues?
That has not been tracked separately because some of these are unlisted companies, but volume figures are available in the
But the Economic Times rating, in terms of we are number 3 all India in terms of.
In terms of revenues, you're number 3, and in terms of volumes of the overall,
the top 6,
you would be in the top 6 in terms of the size. What about Maharashtra? You recently entered Maharashtra. Have you made inroads? And there are, the NCR region you've been completely absent in. Do you have plans to enter?
So forward-looking plans, I know, but in terms of our entire focus, and this has happened across the world. So if you look at India, and that's the first question that you said in terms of fragmented, 4 million passenger vehicles are sold in India. If you look at the top 10 Maruti dealers, all put together is about approximately for 350,000 vehicles that are sold. And Maruti sells about 1.8 million vehicles. So the entire dealership area is fragmented. But if you look at US, for example, AutoNation sells about 240,000 or 250,000 vehicles. And they have a turnover of $26 billion. If you look at our turnover, we are at around approximately $1 billion, a shade less than $1 billion in terms of turnover. That's what we are heading to. So the entire area is in terms of consolidation of things. We started our growth in Kerala. We've gone into Tamil Nadu, Karnataka, Maharashtra, and we are looking at all the opportunities that we can in terms of the high growth market shares, high growth states as such.
So which are the high growth states? Uttar Pradesh, Gujarat,
NCR, and even Andhra Pradesh, Telangana, Hyderabad, which we are not present right now. So
okay, but in the immediate term, say in the next 2 years, which would be the states you would target?
So it also look at opportunities. So we look at in terms of acquisition of dealerships. And in the past 4-5 years, or in the past 10 years, we've acquired dealerships across brands and across states. So we keep looking at opportunities of that. So wherever that opportunity comes and if the strike price is right, we will move into that state, given the other factors that we evaluate in terms of growth, in terms of market share, etc.
Okay. You know, one concern is that maybe you have a bit of a vendor concentration risk. So Maruti is nearly about 48, 49, 47, 48% of your overall revenues. You throw in a Honda, throw in a Tata Motors commercial, and about 77% of your revenues comes in just from these three OEMs, a Maruti, Honda, and Tata Motors commercial. Do you see that as a bit of a risk? Would you like to bring it down by getting on board other OEMs?
We've been with Maruti ever since inception.
That's your first one was 1984. 1984.
So of the first 17 dealers that were appointed by Maruti, we were one of those 17. And we've grown with that company. And we see a future in terms of growth, in terms of what they've done in the last 2 years in terms of SUV growth and all that. And the EV is coming out the end of this year. We see a tremendous growth. Okay. So as John was mentioning it, Maruti market share is about 41, 42% all India. But in terms of service market share, it's extremely high. Because the car park or the number of vehicles on road, and if you look at consistency of models of Maruti, so you have a WagonR that has been a top 10 selling model for the last, I think, 3.5 decades. A Swift Desire, a Baleno. So, and this comes for service. So we service sometimes a vehicle that is a 15-year-old vehicle or a 14-year-old vehicle, which is not possible in most of the other manufacturers. So that's the growth that we're looking at.
And just to add on to what he said, I mean, even now, and this means they're true for the last so many years, 7 out of the 10 top models in India at any point of time, it's a Maruti vehicle. And we have built our strength, our skills, our manpower in servicing these vehicles. So we would like to grow with this strength that we have. That's the moat that we have created, which we would like to
and in terms of concentration risk, if you look at across, there's also the corollary to it saying that do what you are best at. And I think we are best at doing these services or Maruti vehicles, etc. So we've grown a little bit. So we started off with Maruti in our journey. So it was 100% of our. Today it's about 48, 49% as such. So it's not that we have not, we've gone into the high-end vehicles like Jaguar Land Rover. We are the third largest in terms of service in Jaguar Land Rover also. And we are present in whole of Karnataka. Yeah. And we would expand with them also.
So the question is, you have JLR, you have Tata Motors commercial, then why not Tata Motors passenger vehicles? And then why not even look at, say, something like a Hyundai, which is also a very popular car with a pretty good market share. And it comes for servicing too.
Yeah, so this is in terms of, so if you look at, we have approximately 74 workshops or service centers in Maruti. And we do approximately 600,000 vehicles. So our back end in terms of procurement of spare parts, common warehouses, the systems that we have created is all very, I'm saying, robust. If you take on Hyundai or Tata Motors or any of those as of today, we're going to build from scratch. Okay, so the EBITDA margins and the margins are quite similar across all these manufacturers. The only other manufacturer that would be different would be the higher end manufacturer. But that in terms of total volumes are very limited. It's about 40,000 vehicle market across the country and for the last decade or so.
And consolidation is happening in the market here. Recently only we got a LOA for opening up an arena outlet in Bangalore. Okay. So there is enough in the market for us to, in Maruti itself, to gain on.
And at Popular, as I said, we service 1 million vehicles. And we are looking at a CAGR of the service market. So that the highest that you can get is from Maruti. So we're looking at a CAGR of close to about 20-25%, which we have done in the last 18-19% that we have done in the last 4-5 years on servicing. And with BS4 and BS6 implementation, the number of vehicles coming to organized market is far higher than the vehicles that were going to unorganized. Because you need a complete set of equipment, trained manpower. And what we have is we have approximately 10,000 people working with us. Of that, about 6,500 are in the service industry, which are mechanics, painters, tenders, and we have a training institute only for them. And that is our concentration.
Okay, so let's talk about the financials then. Currently, about 68.3% of your revenues comes in from new vehicles, 14% comes in from sale of spare parts and accessories, and about 7.5% comes in from sales of pre-owned vehicles. Now, in FY23, your revenue growth was nearly 40%. What has been the historical growth rate of Popular Vehicles?
Historically, we have been around 10% growth that CAGR that we are getting.
Okay.
But to answer your specific question as to what was the reason why we had a 40% growth rate in FY23. In fact, as we speak in H1 also, we have covered nearly about 58% of FY23's revenues. There are various factors. As Naveen was mentioning, it's the focus on acquisitions that we are doing on both organic and inorganic. Every year, nearly about 7 to 8 service centers organic growth, organic service centers we built. And on top of that, you have the inorganic growth. We have gone into the electrical space, Ather and Piaggio. Bharat-Benz has come into our fold, the Bharat-Benz dealership of Prabal Trucking. All these are factors which are building up growth, and that we will continue to grow as in the future too.
Okay. And also to add on a point, even in the passenger vehicle category, the premiumization, the shift into SUVs and the average selling price going in, plus also the customer experience part that we handle. We have got a 250-seater call center, which, and interacts with every customer, 100% of the customers after every transaction, which helps us enhance the experience where we're creating the customer retention. So they come back to us.
So, what's interesting is, multiple times in the interview, you've said the focus is on spare parts. Historical growth rate and services, right? On services. The historical growth rate of the company has been 10%, but the growth in the aftermarket services has been about 18-19%. Yeah. So double. Yeah. Are the margins also higher in services? In services, and if yes, how would it compare with the overall average?
Absolutely. The entire EBITDA of the group of the organization, more than 57% of the EBITDA comes from our service operations.
So services is 14% of revenue, but 55% of your EBITDA.
Exactly. And in fact, to add to that, we also have another company which is distributing spares. There, another 7% of EBITDA comes from there. So to say, around 62 or 63% of our EBITDA is coming from not the vehicle sales, whereas vehicle sales contributes to the top line. And the bottom line, when you look at it, it's mainly the service and the spare parts which contributes to our EBITDA. And that is why you'll find that year on year, consistently, we have been improving the margins. So, as we say, whether it's the NAV per share, or if you look at the PBT...
John, I was looking at your EBITDA margins, for instance. In FY21, it was 6%, FY22, 5.1%, FY23, 4.8%, and in the first half of the year, it's 5.1%. Yeah. So despite, the aftermarket services growth being much higher, it's not translated into higher margins.
FY21 is an outlier because of the COVID period. There were some cost benefits like rental waivers and some benefits, employee costs and those kind of things. So we leave out FY21. But if you go down, if you go down to the PAT levels, we've been consistently growing up on these 3 years from a 1.1 to a 1.3, and right now we are at 1.4. More importantly, what we can look at is the return on the net worth. Okay. So return on net worth, last year we ended up with about 18%. And this year, for 6 months, it's nearly about 10%. 10% is the return on net worth that we have. So definitely this service pie of it is playing out in our total return on the capital employed.
Just add to that. So if you look at our FY22 PAT was about 34 crores.
34 crores.
FY23 is about 63 crores. Right. This year, first half, we have already clocked 40 crores.
40 crores.
So that growth is there. Second is in terms of EBITDA margins that you spoke about. So the split, as you said, only 15% of the turnover comes from services, whereas 85% is from sale of vehicles and all that. So always the skew of EBITDA would be in terms of the sales thing. Because the turnover, if you sell a vehicle, it's a 500,000 or 5 lakh or 6 lakh turnover. If you sell a truck, it's about 20 lakh then. So your EBITDA margin per se it will not be giving a correct picture in a dealership thing.
Okay, so your gross margins are between 15 and 16%, right? Consistently. Correct. What are the gross margins on the sale of new vehicles, and what are the gross margins on services?
Sales of new vehicles and pre-owned cars hovers around 8 to 9%. Okay. Whereas for services, that's where our focus and concentration on, it's nearly about more than 55% as a group.
And how has the contribution of services to your revenue gone up? It's currently at 14-15%. What was it 4 years back? And would you like to take it up to 20%? And if yes, by when?
Yeah. So if you look at services turnover, if I'm not, John can correct me on figures, is today at 750 crores, which is equivalent to about 15%. About 3 years back, it was about 400 odd crores.
Okay.
So that's why I said we've been clocking about 17-18% consistently in terms of service revenues as such. And also as a contribution towards total turnover. But that gets skewed a bit each year when premiumization of vehicles happen, and hence the average ticket price of the... But in terms of margins, we'll continuously grow. You can add to... Yeah.
Okay. When you enter a new geography, since we are on the subject of PAT, and I know your PAT has gone up as the contribution of services goes up, when you enter a new geography, because of the kind of investments that you need to make to set up your, to set up the dealership for new showrooms, your call centers, for services, etc., is it initially loss-making? The fear is that as you expand geographically, will it depress your margins or ratios in any way?
Please.
So there are two ways we enter a new market. One is the organic, where we set up our own shops. The other is we acquire someone. So when we are getting into a market on our own, John's team does a full calculation sitting with the operations team in terms of an internal rate of returns, in terms of the projections, etc. So based on that only we take a call on going in. So on an average, the payback period, on an average, on service is about 3 years. While
on services?
Alone. While if you're putting a standalone showroom, it goes to about closer to 6.5, 7 years. Okay. So whereas when it is an acquisition, we look at their return on value, and based on the distrust of sale, we negotiate and move in, where the payback period is much more faster.
So Maharashtra you entered last year. So as of now, it's not yet turned around for you, right? It takes 3 years to 6 years.
Yeah, but Maharashtra being an acquisition, this what he said is for an organic growth, we look at a 3-year payback, but for acquisition is much better.
Okay.
So it all depends on the negotiation, on the distress. I mean, what's the kind of, what is our strategy when we get into this market. So all that plays off. And just to add on to what he says, so all this has played out in our EPS. Earnings per share in 22 was around 5 rupees per share. Today in FY23, it's become 10 rupees.
10.2, yeah.
And 10.2 to be exact, to be precise. And in September itself, it's gone better to 6.3.
Yeah, got it. Okay,
Africa is better than us. So.
Let's talk about the IPO per se. Nearly 600 crores of a issue. 250 crore of fresh issue, which you're looking to pare down your debt.
Correct.
The total borrowings of the company are a little excess of 750 crore rupees. You are looking to use almost about 200 crores of the fresh issue to bring down your debt. Correct. Give us the debt numbers, what is the cash on your books, and what is the plan on bringing down debt completely?
Yeah. So typically for our industry, we purchase vehicles from the OEM. And
so you have inventory.
We have. So basically, more than 75% of the debt that we carry is inventory. So that gives you a reflection on the vehicle sale that we're going to do. And so that pays off with the working capital cycle that we have. So as you said, about 700 crores was what we had in December. In September. In December, it's again come down to around over 650 crores. So primarily, this will go to pay off those debts. But typically, since you're working on working capital, normally we carry about 25 to 30 days of stock in our books, or inventory in our books, and debtors are about 10 to 11 days. And so the entire working capital cycle is around 30 days net off.
What's the long-term debt on the books?
Yeah, so those are when we go for an inorganic acquisition.
What is the number?
It's about
80 to 100
less than 100 crores.
Less than 100 crores.
Okay. So the long-term debt will be completely erased and wiped off. Yes. But you will still use to bring down your working capital also with the money that you're raising?
Yes. Correct. So as you mentioned, out of 200 crores, 100 will go for the long term and balance about 100 will go for the reducing the inventory funding.
Okay. And the debt today is 650 crores. Total.
Debt as of December is around 650 crores.
If you look at, so debt has got so when you take debt as on a particular date, it would give a very misleading figure. So if you look at last year, on an average, we had approximately 450 crores of debt.
Yes.
And we did a turnover of 5,000 crores. So it's 12 times. So as he said, most of the debt is on working capital. So if we have 400 crores of debt, you do a 12 times rotation because we carry stock for about 30 days. So it's about 5,000 crores turnover. So as this vehicle sales go up, your debt would go up. But it's basically a 25-day to a 30-day debt factor. And a lot of times there's no interest cost on it in terms of it. Or it would be in the average interest cost would be about 8%, 8.3%.
Less than 9%.
Okay. And this offer for sale is only Banyan Tree. That's the sole investor which is bringing down their stake. So they held about 30% stake. What would it come down to?
About 10.
And
post-IPO.
Post-IPO. And the promoters?
We'll be at around 61% post-IPO.
From 69%. Yeah. Okay. And promoters are not looking to bring down their shareholding in any form or fashion?
No.
Let me compare you with Landmark Cars, right? That's the only other listed player. Absolutely. Popular Vehicles will be the second listed player on Dalal Street right now when you debut. Tell us, for the benefit of our viewers, what's the big difference between Popular Vehicles and Landmark?
So, as I said, the market is large enough for a lot of players to be there. Landmark's concentration is on luxury vehicles. So, they are in terms of Mercedes-Benz. But Popular Vehicles and Services. Jeep, etc. Well, I'm saying our concentration, Popular's concentration is on services and on mass vehicles and a certain percentage of income. If you look at our entire book, we are well spread out in terms of Maruti, Tata Motors commercial vehicles, we have Jaguar Land Rover, we have a spares distribution. But our key focus is in terms of services. And we have done 1 million vehicles on that. And that's how we would tend to grow also, because the EBITDA margins are larger. So I think the key difference is our entire focus is on the service industry, and within the service industry, the body shop, which is the accident repair. So we did approximately probably about 200,000 vehicles of body repair across all the vehicles that we sell, which is probably by far one of the largest in terms of the country. And this is where our growth spurt would be. If you ask me, Landmark versus us in terms of numbers, I think you would have all the numbers better than us.
Yes.
So I'm not getting into numbers per se in terms of turnover, EBITDA margins, in terms of PAT, everything. But in terms of the total size of the market, the Indian market is today at 4 million vehicles. And there are about, as he mentioned, about 2,500 dealers. This would probably go to about 8 million vehicles as per all the industry reports, CRISIL, everything, by 2030 odd. Okay. The consolidation of dealerships would happen. So if you look at even in a market like US, which sells about 14 million vehicles, the highest, which is AutoNation, which is the largest dealer, has got a market cap, it's got a turnover of only $26 billion. Whereas the top 10 dealers over here is probably under $1 billion.
Okay.
So there's a long scope for probably about 8 or 10, and we are hoping that more dealerships get listed. So I think Landmark showed the way. We are Popular's right behind. We probably in the same peer group as such. And I think probably another 3-4 players would get listed at some point of time.
You know, the reason I'm asking is that the shareholders will have a choice, right? I'm purely comparing the numbers. Landmark has sold less than half of the new vehicles compared to you. 1/3 of the number of vehicles which are serviced. You're at 9 lakh plus, and I think they're at a little more than 3 lakh, right? You're at 9.5, they're at 3 lakh. Their margins are higher. Their EBITDA margins are close to 7% last year, and you're closer to 5.5%. And their revenue is only 70% of yours, despite selling half and 1/3 of the new vehicles and serviced vehicles. So in that, just wanted to understand.
So as I said, EBITDA margins will get a skew depending on the number of vehicles that are sold, because as you sell more at the price point of that. Second, as Mercedes-Benz does not allow dealers to hold inventory, that's a difference in terms of EBITDA. Okay. But if you look at sheer PAT numbers, I think last year we were at 64 crore PAT, they were at around 80 crore PAT. So Popular was at 64, they were at 80 crore. This year, first half, we are at a 40 crore PAT, and I think we are at 28 crores PAT. So if you look at the well-diversified thing that we have, and the concentration of services will play out in the long term. And we are not going to be listed in the market for a short-term thing. Yeah. We are looking at a 15, 20-year, 30-year, 40-year view. And as we grow our services, and that's where our concentration is, with the 55% margins on services, you can look at what the multiples would be going forward, from 1 million vehicles to
Just
probably...
to add on to what Naveen mentioned, since you're mentioning the financials figures on EBITDA, finally it comes down to ROE and return on capital employed. So return on equity for H1, they were at about 5.6%, and we were around 10%, as we mentioned earlier. Similarly, in return on equity. Return on capital employed, likewise, they were around 5.5%, and we are at 8.8% for 6 months. So definitely, I mean, that's finally what an investor would look at as to how much return he's getting from his equity.
And what an investor will also look at, and this is the final question, is, as you said, you're here for the long haul, right? Yeah. You're here for, lambe race ka ghoda, as they say. In your case, maybe lambe race ki gadi. But, so, tell us, right, will this industry continue to see a 10% kind of growth, with spare parts growing at 17, 18%, with margins improving? Is this the broad trajectory, without getting into specific numbers, we should expect?
True. So as I said, as Popular, we've been in this market for 70 years. Yeah. That's a pretty long period, 7 decades, and I'm the 3rd generation as such. We're looking at India market having number of cars per 1,000 people at less than, I think it's about 12 to 13 vehicles per...
Currently it's 25.
25 vehicles.
20 vehicles per 1,000.
Okay. If you look at a market like China, if you look at a market like US, etc., it's upwards of 400 to 500. So you look at the growth and look at our population, and the entire growth is top. We're talking of the young age that we have. We have about, I think our average age of population is what? We are the youngest. Yeah. So all these people, as they start doing well, as the per capita income goes up, one of the first purchases is a car and then a house. Okay, so I'm saying the growth runway for growth for the next 2.5, 3 decades, and I think Prime Minister has mentioned that many times, that this is our period as such, and I think that will play out in our industry as such.
Gentlemen, thank you very much for joining in. Naveen, George, Raj, this has been a great conversation and wish you all the best. And thank you, viewers, for watching this episode of IPO KYC.